YouTube and the people that I'm making this video for. So this is the ultimate beginner's guide to learning how to day trade, and I'm making it very simplified. I'm not finna if I throw any like crazy terms in there, I'm gonna tell y'all the meaning. Tell y'all the meanings of it and stuff, but I'm gonna keep this real simple, just keep it in real simple terms that somebody that wants to start day trading and hasn't even like thought about it or anything could like just understand it. So that's the whole point of this video, is for y'all to understand it and leave this with a better idea of what you're doing, and so that way you don't have to go through what a lot of people call tutorial hell, where you're just going through multiple mentors, going through multiple videos, multiple topics, taking in all this information, and then you feel like you don't know what you're doing, and then you're doing strategy hopping, where you're choosing multiple strategies over and over again, and all this stuff like that. It's just, I'm giving you the basics of what you need, and I'm teaching you the way how I see the market. Now, maybe later on, this might not be how you see the market, and you might go off and build your own style, which that is perfectly fine. But in this video, for the most part, I'm just going to give you the basics on, what you need. And right now, I'm going to be putting, I need to pull my finger that way. I'm going to be putting a table of contents right here on the screen. Let that stand there for a minute. The times beside it are the timestamps, so that way whenever you come back to this video and you had a question on a certain topic, you know where, like at what point in the video that I begin talking about that certain thing you have a question on. So yeah, if you have a question or anything like that, said table of contents right there, just come back here, find the time, skip to whatever point in the video you need to. So, and then no further ado, let's start off with number one, is debunking trading myths. So for the first trading myth I want to start off with is trading is a scam. Trading is not a scam. From somebody that's been doing this for 2 years and some change, I can wholeheartedly say trading is not a scam. I put in so much work to the point where I'm at what a lot of my fellow traders would call the break-even stage, which is I'm not making money on my accounts, but I'm not losing money either. And now, instead of just losing all the time and losing all my trades and stuff like that, now I'm actually winning trades now, and now I'm just working on getting better. I have my own style of trading and all that stuff like that. So I've been seeing progress, and I've been moving forward, and I've actually passed a phase 1 of a 2-step phase challenge for a prop firm, which I will be going over that in the trading platforms and brokers section, just to let y'all know, since that's what I trade with before I move into my live accounts. So yeah, that's trading myth number 1. Trading is not a scam. This is very real. The possibilities are very much there. Now, debunking trading myth number 2. The trading myth number 2 is you need a lot of money to start. No, you do not need $25,000 to start. You don't need $100,000 or $50,000. No, you do not need a lot of money to start. Then this is going to go into the second topic, but there are brokers that allow you to start with some even as low as $10 minimum. But a lot of them are like $100 minimum, some $15, some $10. I don't know if I've seen a $5 minimum one yet, but you really do not need a lot of money to start. And to be honest, you putting $100 in there is more than enough to get started. What's more important in the beginning is making sure that you have the right knowledge. Because if you can't learn the skill of trading, then it doesn't matter how much money you put in there, because you don't know what you're doing. So you're just gonna give that $100 to the market instead of taking out $100 from the market, or taking out $1,000 from the market. So yeah, no, you don't need a lot of money to start. That's only if you're using a regulated broker, which, like I said in the second topic, we're gonna go over trading platforms and brokers and stuff. But yeah, you don't need a lot of money to start. Literally like $10, but $100 is a pretty good place to start. Now, debunking trading myth number 3. What would be the third one? Let me think. What would be the third trading myth? Oh, this is a big one, because I've been hearing this one a lot. Debunking trading myth number 3. You can only make money when the market is going up. That is completely false. Completely false. You can make money if the market is going up or if the market is going down. And seeing as how I don't have this explanation in a certain topic of its own, I'm going to explain it right here. But in trading, you have the buy button and the sell button. And all the buy button means is you're predicting that the market is gonna go up from where you enter at, or where you enter a trade at. And all the sell button means is you predict that the market is gonna go down from wherever you enter a trade at. That's all buy and sell mean. I'm not gonna go too much deeper into it, but that is like the simplest way of explaining it. Buy just means you think it's gonna go up from where it's at right now, and sell just means that you think it's gonna go down from where it's at right now. So you can make money whether the market is going up, whether the market is going down. It does not matter which way the market is going. You can make money both ways. Some people only prefer to be in buy positions only, or positions where they think the market's going up. Then there's traders that only prefer to be in sell positions, which they think the market is gonna go down. And if you're someone like me, which I feel like is the majority of traders, you're okay with both. You are okay with buying and you're okay with selling. Because like I said, at the end of the day, all it is whether or not you think the market is going to go up, or whether you think the market is going to go down. So, yeah. Let's see. Debunking trading myth number 4. I'm trying to go fast, but this video is going to be long regardless, because I'm trying to give y'all actual value, and I'm not trying to speak too fast or anything like that and hurry up and make it a small video, because I'm trying to speak at a pace and like at a slow pace and speak in such a way to where y'all can understand it, and understand me clearly. So debunking trading myth number 4. You can lose more money than what you put in your account. That is false as well. If you put $100 into a brokerage account, if you lose that $100, you can't lose more than what you put in your brokerage account. So if I put $100 in there, I can't lose more than $100. Once I lose $100, the account just goes to zero, and all I have to do is just put more money in there. It does not work like you put $100 in there and then you go and you're down $1,000, and now you gotta put $900 back in there to get the account to zero. That's not how that works. Once you lose the amount of money that you put in there and your account goes to zero, that's it. You only lose the amount of money you have in your account. You cannot lose more than that. A lot of people like to think that they're like, yeah, you can make money, but you can lose a lot of money too. You can only lose as much that's in your account. And also, the people that say that, you have to realize too, they have either one, not have traded themselves, or B, haven't stayed in this long enough to actually see results, or weren't taking this seriously, or were just trying to hop into this thinking it was a get rich quick scheme, and they got chopped up in the market. They lost, thinking that this was going to be a win only kind of game, like you only win, you never lose. And then when they lost and stuff like that and started losing money, they just quit, and they're like, nah man, that mess is a scam, because they don't understand it, and they're afraid of it because they don't understand it. So they're like, I'd rather just do my simple little job, my simple little safe, quote unquote safe 9 to 5. Like, they can't get fired randomly for that too. And yeah, so don't listen to what people say about the negative things about trading, because you'll never hear somebody that's actually in this for the long run and actually takes this seriously say the things about trading that the people that quit or weren't taking this seriously will say. So that's trading, I think that's trading myth number 4 that I just said. So debunking trading myth number 5, what would that be? I'm trying to think of more trading myths that people have said. There might not be a number 5. Let's see, we went over people saying it's a scam. I'm trying to think, I swear there was one more in my head. Yeah, guys, I can't think of any more trading myths. Those are the like real big ones that I can think of right now. Oh no, this is a real big one. Trading myth number 5, that you can get rich quick with trading. I'm not going to say you can't make money fast, which yes, you can. That's why a lot of people are attracted to this. That's why a lot of people want to do this, because they know you can make. Yeah, I mean, once you get to, if you stay with this long enough, and you believe that you can take this to this point, because trading is something to where how much money you make is only based on you. It's only based on how much you think you can make, or how much you believe that you're capable of. Some traders are able to make the average person's yearly salary in a month. Some people in a week, and really good ones in a day. And that just comes down to more capital. But more capital is nothing without the skill. So if you don't have the skill, it doesn't matter how much money you have in that account, the money will never stay, and it won't grow unless you have the skill and you understand what it is you're looking at on this chart. So yeah, this is not a get rich quick scheme. Like I said, I've been doing this for 2 years and some change, and I just finally passed a prop firm phase 1 of a 2-step phase prop firm challenge. So, but everybody's journey is different. Some people it only takes 6 months. Some people it may take 5 years. For me, I'm not trying to put a time limit on it, but I feel like I'm really, really close to being like where I'm gonna start making money from this, and some good money. So, especially since now that I have a way better job, I'll have so much more time to myself, or time to put towards this now. And then once I start doing this full time, I'll start coding. And well, let me not get off track. We're here to teach y'all. So this is not a get rich quick scheme. Do not expect to come in here and just because you watch this video that, I see how the candlesticks work, or I see the market structure and all the other things I'm gonna show y'all in this video, and think that you're going to just hit it right out the gate. Just focus on learning the skill and stuff like that. I'm going to go over the psychology behind everything later, so I'm not going to say it all right now. But yeah, just don't expect to get rich quick. It's going to take some time, but I promise if you take the time, you take this serious, and you don't give up, and you just go at this every day and take mental breaks whenever you need to, this will be something that'll replace your 9 to 5, your job. and you will be able to live off of this. And then you'll be able to go on vacations whenever you want, stay home as much as you want, go out and do whatever you want. You won't ever have to worry about the price tag on things. You'll have the freedom to do whatever you want. You'll be able to, if you have kids right now, you'll be able to spend time with them, or if it's just you and your spouse or your significant other, you can spend a whole bunch of time with them, or you can take alone time to yourself at the house with yourself while they're at work, or once you get to a certain point, if you want to make them, stay at home, if that's a goal of yours, then that. Me, I'm trying to go on vacations and stuff like that, so I'm trying to just chill and just live life on my own terms. I always wanted to be an entrepreneur since I was a little kid in 7th grade, but I was always in the I always had the people talking around me about go to college, get a good job, work, yada yada, save all your money, yada yada, and then enjoy your one vacation a year, and whenever you're 60, or hopefully you'll be able to retire whenever you're 50, 60. I'm like, that's not what I want. I want to live life right now while I'm young. And this trading is something that allows that. Something that allows me to be free, make as much money as I want to, and allow me to be able to live life and not have to wait until I'm already middle-aged to a little over middle-aged to start enjoying life. So yeah, now let's get into, now that we're done with the debunking trading myths, I don't think I got to all of them, but I think I got to the main ones, the main big ones. Now let's get into topic number 2, which is, I swear I think I said debunking trading myths is topic number 2 at the beginning. Oh well. So real topic number 2, if I did, is the trading platforms and the brokers. Now I'm gonna put it on the screen. I'm gonna put it on the screen right over here, so that way y'all can go and download them and take a look at them. But well, I'm gonna show y'all the ones I use, since we're gonna be since I'm assuming y'all are gonna be beginning with $100 or maybe a little more. Somebody maybe 1,000 or whatever. If y'all start with your own money, which I don't recommend, but we're gonna go into this. So the first one over here off to the side, or actually it's gonna take up the full screen, is TradeLocker. So I'm not sponsored by them or anything, or the other one I'm fixing to mention, but TradeLocker, you can get this in the App Store. I'm not entirely sure if you can get this in the Google Store or whatever it's called on Android. I forgot. It's been forever since I had an Android. But yeah, this is what I use. They use the same chart as the other broker that I'm going to mention. It's actually the other broker's charts that TradeLocker uses, but this is actually the chart that you're seeing right now. So I recommend this for people that are really starting, just starting, that this is a real simple way of looking at the market. It's real smooth. It's really smooth. It's a smooth platform. They typically run smooth. They tend to do maintenance on the platform every other Sunday. It used to be every Sunday at one point, but now I think they're doing it every other Sunday, which I appreciate that they're trying to make sure that their app is being maintained, and they're getting rid of bugs, if any, and doing any fixes they need. Or I'm in their Discord, so they tend to listen to people in their Discord, what they want added, so they do add some stuff if enough people in the Discord want a certain feature added. So yeah, I recommend TradeLocker heavily for anybody starting. Ever since I have gotten and I've used them, it's been a pretty smooth experience. Now y'all can go and look up on YouTube how to set up TradeLocker and stuff like that. I'm probably not gonna go into it on this video. I might make it a separate video, but for the sake of everything else we gotta go over, I'm not gonna go over it. So yeah, the other one is called TradingView. Now, TradingView, same thing. You can get it on the App Store. I don't know if you can get it in the Google Store or not, but TradingView. Now, both TradingView and TradeLocker, you can get the desktop version. So if you're doing like how I'm doing, excuse me, if you're doing like how I'm doing right now, where I'm on my computer, you can just go into a search bar of Microsoft Edge or Google Chrome or whatever, and just type in the search bar either TradeLocker or TradingView and press enter, and it'll show you, the website for it, and then you'll just make an account and yada yada, all that. So TradingView's charts are the same as TradeLocker, but what I mean by that is TradeLocker uses TradingView's charts. So the charts you see on TradeLocker are the same as TradingView. So TradingView is really where I started out at, but the reason why I switched over to TradeLocker is because TradeLocker, which we're going to get into this on this topic, is TradeLocker uses or partners with unregulated brokers, whereas TradingView partners with regulated brokers. Now, the regulated brokers are brokerages that have regulations and rules and all that stuff like that. Basically they're certified. So we'll say more of your money is also protected in there, just in case they go under and stuff like that, or the brokerage goes out of business or whatever reason. Your money's safe. You'll still be able to take your money out. These are the type of brokerage accounts that y'all were thinking about whenever y'all say $25,000 and stuff like that, where you thought the minimum. So one of the regulated brokers I was using, called Forex.com. Shout out to them. I don't use them because I have a different broker, but and also I trade prop firms mainly right now, so I don't really use my broker either. But Forex.com. If I am wrong, I know this is correct. They are a regulated broker, but I could be wrong in this statement, but I don't think I am because I put money on there, so I'm pretty sure this is right. But I'm pretty sure Forex.com, their minimum amount that you have to put in is $100, which is definitely rare for a regulated broker to do that, because typically they want you to have a decent amount of capital in there, because it's kind of like a way of, I guess, protecting yourself from real volatile markets like gold, where gold you can make a lot of money. That's what I have up on the screen right now, the XAU/USD up in the top left corner. That's just the sign, the little abbreviation for gold on charts. But yeah, that's a regulated broker. They just have the rules and regulations and stuff like that. That basically, if they go under they just have to follow certain rules and stuff. And if they go under or go out of business and stuff like that, then, basically your money's protected. And even though if the company's gone, you can still, pull all your money out and stuff like that. Or they'll probably send your money back or liquidate your account and give you your money back. But unregulated brokers don't follow the same rules as regulated brokers. But unregulated brokers are the brokerages that I was telling y'all about, that minimum $10 you need, or minimum $100. Well, not really minimum $100. A lot of them are just minimum $10 or minimum $15 and stuff like that. But they don't follow the same rules that regulated brokers do. So a lot of unregulated brokers still follow rules, but it's more they try to follow their own rules and structures and stuff like that. So basically, you can put money in there, but say if one of the if they go out of business and you have money in that account, if you had people that were actually good, a good brokerage and stuff like that, they'll let you know that, hey, we're about to go under, we're about to go out of business. You have so and so days to take your money out of the account, or it'll be gone. There's nothing we can do about it. Yada yada. They'll let you know. So the first ever unregulated broker I used was called 24K Markets, and recently, like at the end of 2025, I'm pretty sure it was, towards the end, they went out of business apparently, or something happened, and yeah, they apparently sent me an email, which thankfully I didn't have the money in the account because I did not pay attention to my emails at all. But they sent me an email letting their traders know that, hey, the company's not gonna be up, like it's done, yada yada. So y'all have until this date of this time to liquidate all your accounts, take out all your money, and if you don't, the money will be lost and there's nothing they can do about it. So they let us know, or I'm assuming a lot of people did what they needed to do, and then that was it. Now I'm on a different broker. So yeah, that's the 2 trading platforms I would recommend if you're trying to trade like stocks, indices, metals, stuff like that. And then there's different platforms for like futures and stuff like that, and options is different as well too. Y'all can just look up a different video about that, but I'm just giving y'all the 2 trading platforms for the regulated brokers, I'm giving y'all the trading platform to use with the regulated brokers and the trading platform to use with the unregulated brokers. So we're gonna go over this real quick before we go into how the candlesticks work. We're finally getting into bread and butter of this. So Trading View is for the regulated brokers. Trade Locker, which is what you should start out with, is for the unregulated brokers. And you also cannot start looking at the charts and stuff like that. Trading View you can, but Trade Locker you can't. But on Trade Locker you can't start looking at the charts and stuff until you have a broker. Now it's free or a majority of them. I haven't come across one yet that wasn't free, but it's free to make a brokerage account and stuff. So just find one and make an account with them, and just put what trading platform you use, which in unregulated brokers cases you would put Trade Locker if they're partnered together and stuff like that. And then they'll give you the credentials for your Trade Locker account. You'll go sign in, and then you should be able to look at the charts. Now the one I use, I forgot, I gotta do inverted. The one I use over on this side over here is Gates FX. I'll put up a picture of them right there, covering up the whole screen again, most likely. And then Gates FX is the one that I use. I'm not sponsored by them either. But yeah, they're the ones that I use. I saw that they were new. I looked into their rules and stuff and how they function and all that good ish. And honestly, I like them a lot. So I'm gonna give them a chance whenever I start building a live account. And we're gonna go from there. So alright guys, now topic number 3. We are 30 minutes into the video as we speak. So we're about to be 30 minutes. So let me make sure over here on my OBS studio y'all can see what I'm seeing, because I don't have it lined up perfectly. So number 3, this one's gonna be a real short one. We're gonna go over how candlesticks work. This is really, really simple. You're probably looking at this and wondering what the heck is going on. I understand that. Now, this is really simple. I'm gonna tell y'all the terms too. So these yellow candles are going up, and these black candles are the candles that are going down, right? So in these terms, we have bullish and bearish. Bullish and sorry, I don't know if I'm saying it like that, but bullish means, in market terms, it just basically means going up, right? Bearish just means going down. So in this case, this is a bullish candle because it's going up, and in this case it's a bearish candle since it's going down. Now I'm gonna repeat it one more time. Bullish means going up, bearish means going down. Like I said, I'll put timestamps so that way y'all can come back to this topic if y'all need to, something you don't understand. But it would be best, and it would be best to write some of this stuff down. So just pause the video as much as y'all need to, and yeah, we're gonna go from there. So right here, how bullish candles operate is they have an open and a close. So where all that begins is with bullish candles, the open starts out at the bottom. So in this case, I'm on a 15-minute time frame right now, right? At the start of this candle, it's going to open right here where this line is at, or right here at the bottom. It's going to open right there. And then after 15 minutes have passed, the candle is going to close. And this right here at the top of this yellow part, which is called the candle body, this is where the candle closes at. Now that's only for bullish candles, bullish meaning going up. Now bearish candles are just the opposite. They open at the top and they close at the bottom. And remember, bearish means going down. So going over it one more time. Hold on. Thank you. If anybody said bless me for any reason, I just said that because Corey Kenshin does that with his viewers, and I find it funny, but kind of a little nice way to kind of interact with your viewers. So yeah. But yeah, like I said, bullish going up. The candles they open at the bottom and they close at the top. And then the bearish candles, bearish meaning going down, it opens at the top and it closes at the bottom. Now, these lines that are sticking out of the bullish and bearish candles are showing us where the candle body has been. So basically all that would mean is like this bullish candle, it opened right here. The candle body went all the way down to where this wick ends at, and then it came back up, and as it's coming back up, it leaves that wick behind, right? So then the body keeps going all the way up to here, and then the body comes all the way back down. And after 15 minutes, because I'm on the 15-minute time frame, this candle closes right here at the top, leaving this wick. So all the wicks is just showing you where the candle bodies have been. So right here on this bearish candle that we've been using, price opened here at the top. It came up to where this wick ends, comes all the way back down right here to where this wick ends, and then after the 15 minutes, closes right here at the bottom. So all the wicks do are they just show you where price has been. So I'm gonna move it to a 1 minute, and I'm gonna show y'all. This is just going to go like 1 minute at a time. So as y'all can see, the next candle is black, right? So we opened up here. And we're not closed yet, because if y'all can see out to the side, we still got 14 minutes left before this candle closes. So let's do 1 more minute. As y'all can see, price came down right here and then went back up, making the bottom wick longer. Now let's see what happens now. Now price eventually came back up here and then came back down here, making the top wick longer. Body went down a little bit, bouncing back and forth, going up. Now see, the top wick got a little bit longer because price went up a little bit more and then just came back down. So now let's see. Now see, look, the bottom wick went down again because price or the body of the candle, same thing. The candlesticks just represent price movement. So if y'all ever hear me say price went down here or whatever, I'm just referring to the candlesticks, because that price, the candlesticks is a representation of the price of whatever you're trading, basically. So as y'all can see, the candlestick body went down in here and is right here. If I click one more time, this candle has now finished, and this is what the candle looks like after 15 minutes. So yeah, that's pretty much how candlesticks work, guys. Like I said, it was pretty simple, right? Nothing crazy. Little quick recap before we go into topic number 4 is bullish just means up, bearish means going down. A bullish candle opens at the bottom and it closes at the top. A bearish candle opens at the top and closes at the bottom. Excuse me. The wicks just show where the candle body has been, or where it went to but failed to close at. So that is the basics of how candlesticks work. Real simple, nothing crazy. It's just that's really simple. So yeah, now we're gonna get into topic number 4. Halfway done with the video, or once we finish with this topic, we'll be halfway done. Is market structure. Now, I'm going to move this over here. Move the candle, get the candles out of the way. So, do I have my path tool? I do not have my path tool. Path tool. Got it. All right, guys. So, markets have this thing called market structure, where they make highs and lows throughout the market to basically form what is called either an uptrend or a downtrend. All that is just, I'm gonna show y'all what an uptrend would look like. Pretty simple, right? That's all an uptrend is. It's just when price is trending up. Now, as you can see, price doesn't go just up in a straight line. It's making highs and lows, right? So what an uptrend consists of is what we call a high, a low, and then higher highs and higher lows. I'm gonna repeat that again. An uptrend consists of a high, a low, and then higher highs and higher highs and higher lows. Almost messed up right there. So in this case, as y'all would see right here, we have a low, we have a high, and then right here we have what is known as a higher low. Now, it is called a higher low because this low is higher than the previous low. Pretty simple, right? Same in this case. We have a higher high. Why it's called that, as you could guess, is because this high is higher than the previous high. And then an uptrend is just consisted of price just repeatedly making these higher highs and higher lows, as y'all can see, and then it just keeps on doing that. Now I'm gonna show y'all a downtrend. Downtrend is just the complete opposite of an uptrend. So I'm gonna go here. Downtrend instead is consisted of lower highs and lower lows. I'm trying to clear my voice or clear my throat because starting to get all cold. I'm recording this during the freeze, or the freeze if it does actually freeze. And yeah, I'm gonna need to go take some medicine here in a minute. But basically, as y'all can see, is we have a high right here, right? We have us a low, and then right here we have us a lower high. Now it's called that because this high is lower than the previous one. Now right here we have us a lower low because this low is lower than the previous one. And an uptrend just consists of making those lower highs and lower lows over and over and over again. So that's the basic of market structure and trends. There's an uptrend, a downtrend. An uptrend consists of higher highs and higher lows, and a downtrend consists of lower highs and lower lows. So let me get rid of this. Now you'll see on the chart that it'll do this sometimes. So we're in like a basic uptrend, right? So this is right here, we have a low, high, higher low, higher high, higher low, higher high. Then we have our higher low, but as y'all can see, the market puts in a lower low right here, and then it then breaks past this. It then breaks past this higher low right here, which is what we would call a break of structure. That's what this is right here. So a break of structure, all that is just like how I told you, in this case, an uptrend is made of higher highs and higher lows consistently made. Well, a break of structure is just basically when price is breaking that said structure. So instead of continuing with the higher highs and higher lows, price is now forming lower lows and lower highs. And that line right there where it broke that higher low is where the break of structure was at. Because if it was still going in an uptrend, the next low formed would still be above that higher low. But as you can see, we broke down past it and the new low is being formed lower than it. That is what is called a break of structure. All right, so let's see. Is there anything else I need to explain with market structure? I already explained to y'all. Uptrend. I already explained to y'all the higher highs, higher lows, lower highs. What else? Just explained to you what a break of structure was. Explained the candles and how they work. Good thing I wrote the table of contents down, so that's why I'm having so much structure with this video. There's this thing called a change of character, but that has to deal with from my experience and from the mentor that I learned from, change of character has more to do with a certain PD array. I'll go into what PD arrays are in a little bit. That'll be in section 6. So yeah, that's pretty much it for market structure. So yeah. Now, not everybody uses market structure in their strategy. For instance, I don't. So, but I feel like it's good for somebody that's starting out to have that fundamental knowledge. So now I'm going to show y'all an actual example on the charts, and also you guys are gonna go on to Trade Locker, which I'm assuming majority of y'all are going to be starting off there, and y'all are going to, I want y'all to go on there even while we're doing this, or if you come back to these topics, I need y'all to be either doing it along with me, as far as like I need y'all to be looking on your own charts and being able to like find these highs and lows and everything I'm pointing out, and just practice seeing it, because the more y'all practice seeing it, y'all get used to it, the better it'll be. Now, what I see as highs and lows in the market are, maybe a lot of people see them differently, but what I see as highs and lows in the market is like right here, this is a high, this is a low, this right here was a higher high, this right here broke past that higher low, and then let's see, we went up, here's another high right here, you see right here, there's another low right there, we have a high right over there, then we have a low right there. All right. Let's go a little more over here, show y'all, but like you can see, like it's a little more clear as far as like you can see how they're being formed, like where the highs and the lows are at. You can kind of like see the price fluctuations. So like for instance right here, you see there's a high because like price came up here and then started going down, so that's a high. Price came down here and started going up, so guess what, that's a low. Came up here and we started moving down just a little bit, that's a high. This was the lowest point down here before we started moving back up, so right here is the low. Went all the way up here, moved down, we have a high again, and then right here we have our low, and then it started going up. Now going back to our break of structure thing, it is only a true break of structure whenever you have a candle body close past it. And I see two great examples of when it is a break of structure and when it's not a break of structure. So right here, for example, on this low, this is not considered a break of structure because, as you can see, all price did was wick pass through this. That's what these lines are called. I don't remember if I told y'all, but these lines are called wicks. And remember, like I said, that's when the wicks just show where the candle body has went before, but it didn't stay at. So as you can see, it wicked through. You don't have a candle body close through it. So this is not what's considered a break of structure. Now this over here is what would be considered a break of structure. Sorry, I'm trying to make sure the line's kind of lined up. That over there. This right here is what's considered a break of structure, because as you can see, we have a candle body close past the low. So this is what would be considered a break of structure. Now, as y'all can see, even though we broke structure, we still headed back up. Sometimes break of structures can be a fake out if you decide to trade using market structure and stuff like that. Now, me personally, I don't see this as a break of structure because I don't use market structure when I trade. I see this as what would be our next term that we're gonna go over. And in this case, this is a really good opportunity to get into a buy position, which as y'all can see would have been right because we went all the way up here. And actually, when I was back testing, I actually did catch this trade. I actually got in on this candle right here, stop down, put my stop loss down here, and then price just ran up here, that would have been a lot of bread, a couple thousand right there. With how much I usually risk, that would have been a couple thousand. How long? 13:45. Say I got out right here. 20:45. Excuse me. About 7 hours. 7 hours. I think it was like 4.2k. So 4.2k in 7 hours. It's pretty good. That's more than the monthly salary. Alright, yeah, that's more than the monthly amount that I was making at the job that I just left from. And I made that in 7 hours. So, but anyway, yeah, that's market structure. That's how that works. So now we're finna go into topic number 5. We are an hour long in this video, but we already knew how long this hoe was gonna be when we came in. Because I'm giving y'all all the, not all my, I can give y'all my info, but I can't give y'all my experience. So even, I might not even be giving y'all all my info. Like, there's a lot of stuff I know, but there's a lot of stuff I know about the market and a lot of stuff about Peter raising different strategies and yada yada yada. But I'm just teaching y'all the basics, and I'm just teaching y'all what I know, or what I feel like are the things that y'all need to know. I'm not gonna sit here and just give y'all every single piece of information. I'm just gonna give y'all what I feel like y'all need to be successful, and if y'all want to, y'all can use my same strategy, or you'll go out and find your own way of trading, which I feel like is better. But if you find that my way of trading works for you, then that's completely fine as well. So now I'm gonna leave these purple lines on here because this is actually perfect to go into number 5, is liquidity. Now, what liquidity is areas where there are resting stop loss orders in the market. Now, me saying that is perfect to go into this because I didn't make a topic for this because it was so small. But this right here is how you would gauge your risk. So this, all this is the line right here that's between the green box and the red box is just the area where you entered the trade at. The red box right here is showing you like the amount of risk, like the area that you're like putting the risk in, I guess. Because basically how this works is this middle line is where your entry is at, where you entered at. The bottom of the red box is where your stop loss is at. So basically all that's saying is if price comes down and, you know, goes past this or taps the bottom of the red box, it's getting you out of that trade. It's taking you out of the trade, and you'll lose however much you were risking. Versus right here at the top of the green box, if price goes up and hits it, it'll take you out of the trade, and it'll take you out at however much you were projected to make. So like for instance, well, like I just told y'all, I entered in somewhere like around here at the line. So I put my stop loss right here at the bottom, and I entered in when this line was up, or sorry, man, my voice, it's hard to clear my throat. But I entered in when the candle body was here. It went all the way up to here, and I had my stop below here at this line, right? I either put it up to here, but then I decided to move it up a little bit more like that. I moved it up my take profit. This is what they call TP, which is short for take profit. And yeah, I don't think that was the best way I could have explained it, but it's so simple. Now what this risk to reward ratio is basically saying that for whatever I'm risking down here, I'll make 4.1 times that. So let's say like my usual risk, I'm risking about like $550-$60, right? If price comes up and hits here, that'll make 4 times that. So let me get the calculator out. The calculator. Y'all can't see it, the calculator on my screen, but we said 556 And the risk was we could make 4.1 times what we were risking. So that right there, once price hit up here, the top, it would have taken me out at $2,279. 2.2K. And we entered in at 13.45 and we got out at 14.45. So it took me 1 hour. It took the kid 1 hour to make, my goodness, 2.2K. Isn't that crazy though? Like, a lot of people, I used to have to work, where I was at right now, I used to have to work a 72-hour week and a 60-hour week to, back to back to get a $2,300 2-week paycheck. And with this trade right here, I would have made that in 1 hour. With all I had to do is just press the buy button, and then I would have just went off and probably played the game and chilled or whatever I wanted to, and would have came back an hour later, and boom, I would have been up 2.2K. You see the difference? At work, I would have had to put in work and do all this extracurricular stuff and do all this lifting and be there for 12 hours every day that I was there and do that for 2 weeks straight just to make 2.3K. Whereas this, I just have the knowledge and I'm using the funds from the prop firm, and I just pressed buy, and I just probably went to, I could take a nap if I wanted to, and would have woke up and would have made that same amount of money in just 1 hour out of the day, without all the extra work, without all the extra time and stuff. It's just the knowledge that I have. Y'all want, in life, guys, y'all want to get paid for using this, not your body. You want to get paid for using this, because I promise you, from what I've seen so far, being 21, I just turned 21 about a month and 2 days ago, is that you get paid a lot more for using your brain instead of using your body. So, yeah, that's how those boxes work. I'm going to go back over it one more time, real simple. This middle line right here is where you entered at. This right here is where what is called your stop loss is at. And if price comes down and goes past it or taps it, it's taking you out for however much money you are risking. So in my case, that would have been $556. So once it came down here, I would have lost $556. Vice versa, if price came up here, this is what's called take profit, for short TP, is price would have taken me out for however much money I could have made depending on how much I was risking. So in this case, my risk to reward ratio is 4.1. Basically saying is, since I'm risking $556, if price comes up here to take profit, I'll make 4.1 times whatever it is I'm risking. So in that case, I would have made $2,200. So that's how that box works. This is the same box, just different. It's just, this is for sell position. The box is just flipped. That's literally it. So liquidity, now we're going to get into liquidity. Like I said, liquidity is just where stop loss orders are in the market. So for instance, like say in this instance, I'm trying to sell right here, and I put my stop loss up here for whatever reason. As you can see, I entered in here, it started going down, started going up here, and then boom, that yellow candle right here stopped me out. That hit my stop loss. Well, that is what liquidity is. Liquidity is basically just highs and lows in the market where stop loss orders are resting. Now, as y'all can see right here, what price usually does is price targets liquidity, and price moves based off of liquidity, or moves to target liquidity, basically. So, for instance, as y'all can see right here, price came and took out this low, which this is liquidity. You know, in some instances, somebody entered in here and they put their stop loss, down here. Price did its thing, yada yada, and it came and it took this out. Now, price typically moves to liquidity and away from it to target more liquidity. So in this case, as y'all can see, price took out what is called sell side liquidity, because sell side is basically just, the bottom part, and buy side is just this, because how I said buy is up. This is what they call the buy side or the upside, versus sell side is the downside right here. They call that too, the upside or the downside. So right here we took out sell side liquidity or downside liquidity, whatever you want to call it, coming into the next topic that I'll tell y'all in a minute, which is a fair value gap. And then after taking it and coming into this fair value gap, we then got a little bit of momentum coming out of here, and then eventually over time momentum started coming in and we got out of there. So yeah, all liquidity is just highs and lows in the market, and there are stop loss orders chilling at these highs and lows in the market. That's literally all liquidity is. I'll say it one more time real slow, and I'll try to say it a little bit better just in case I said it a little, in a way that was confusing. Liquidity is just highs and lows that are formed in the market, and all of these lows and highs have stop loss orders above them. That's where they're resting at, and price moves by targeting liquidity. So yeah, that's liquidity. That's it. Like I said, these purple lines would be an example of where liquidity is resting. And as you can see, the purple lines that have like a candle body closed past them, or like the wick past them and stuff like that, is just showing you that liquidity was taken and stuff like that. So for instance, right here, boom, price took liquidity right here and then started heading down to target this liquidity. And then once price targeted this liquidity, it then ran up and started targeting this liquidity right here. Perfect example of what I was just saying. So all right guys, we're almost done. We're on topic number 6 of 8. So number 6 is about fair value gaps and inverse fair value gaps. So fair value gaps are made based off of a 3 candle sequence, where I just showed y'all actually a fair value gap. So we're gonna take these 3 candles right here. We have candle 1, candle 2, and candle 3. How a fair value gap is basically just a space between these 3 candles. So as y'all can see, from this wick to this wick, there's a space. That space is a fair value gap. Now, price is also, just like liquidity, attracted to these fair value gaps, and just how price reacts off of liquidity, price also reacts off of these fair value gaps. And these are like good areas that price gets reactions off of usually, to then go in whatever direction price wants to go in. Now I'll show y'all an example. I'll show y'all another example. Candle 1, candle 2, candle 3. There's a space between the wicks. So that right there is another fair value gap. And as y'all can see, price came into here and then reacted and got out of there. Just and vice versa. Price came down, also tapped in this one, and then price went back up. So I'm gonna show y'all an example of what is not a fair value gap. You have candle 1, candle 2, candle 3. As y'all can see, this wick overlaps with the third candle's wick, therefore not leaving a space. So in this instance, that's not a fair value gap. There has to be a space between candle 1, the first candle's wick or body, and the third candle's wick or body. So usually you'll do it from wick to wick. But like, say if a candle is like fully, like the first candle is like fully solid, there's no wick, and then the third candle has a wick, you would just mark the box up from the first candle's where the body ends to the third candle's wick, and that's still a fair value gap. So that's how you find fair value gaps. Remember, they're a 3 candle sequence, and how the fair value gap, how you spot them, is there needs to be a space between the first candle's wick or body and the third candle's wick or body. But typically it's gonna be wick to wick, but I'm just saying from wick or body just in case just in case there's an instance where candle 1 and 3 don't have wicks. So inverse fair value gaps are basically just this. This is a perfect example. So as y'all can see, we have a fair value gap right here. We have candle 1, 2, and 3. First candle's wick to third candle's wick. Boom. We have a fair value gap, right? As y'all can see, this black candle closed below this fair value gap, then making it an inverse fair value gap. So the orange fair value gaps are the bullish fair value gaps, and then when I turn them black or gray like this, that represents an inverse fair value gap. So it's kind of like it's flipping it, right? So like how I just told y'all, the orange ones are bullish, right? So whenever price comes and hits a bullish fair value gap, you're expecting for it to go up, right? Like give it, you know, a little more momentum or a little more volume to go up. Well, when price inverses it into a bearish inverse fair value gap, it's then giving it the power to potentially give price the volume to go down. Because, you know, remember, bullish means up, bearish means down. So in this sense, or in this example, price went here, and it has to be a candle body close. It cannot wick past. Wicking past the bottom, like how right here, does not make it a inverse fair value gap. Damn. It has to be a candle body close. As y'all can see, price came back up and closed above it again. So at that point, that's what I call price making the inverse fair value gap not mean anything. So I then just get rid of it. Now right here, we start off, you know, one, 2, 3. First candle's wick to second candle's wick. We start off actually with a bearish fair value gap, and as y'all can see, price comes up and closes above it, therefore turning it into a bullish inverse fair value gap. And as y'all can see, price came back down, touched it, and then went back up a little bit, and then came back again, touched it, and then went back up again. So both bullish fair value gaps and bearish fair value gaps can be inversed, and all they will do is just all they would do is once they're inversed, they'll just change to the opposing terms fair value gap, basically. Or once they're flipped, they're called inverse fair value gaps. So yeah, that's pretty much how fair value gaps and inverse fair value gaps work. They pretty much work the same. It's just, you know, inverse fair value gap, if price closes past a fair value gap, it just inverses it, or aka, you know, flips its you know, its properties basically. So yeah, that's it. Alright guys, we're an hour and 10 minutes in now. Now we are, well, I might edit or chop the video up, I might not, we'll see. But as the point of where I'm recording right now, we're an hour and 10 minutes in. Now we're gonna get into topic number 7 of 8, which is the Fibonacci tool. This one's gonna be real small. So the Fibonacci tool is this thing right here. Bring it down. Just bring that down just a little bit. There we go. The Fibonacci tool is this thing. Now, when y'all first get it, it's not going to look like this. So do not expect this. It's going to be a bunch of colors, and it's going to be everything everywhere, and lines, and yeah, you're just going to have to adjust it. Can I show y'all my settings? Yeah, I can show y'all the settings for the Fibonacci tool. But basically, all I do is use this tool to get targets. So what I mean by that is I'll draw the Fibonacci tool low. I can just show y'all. It'll be more easy to explain it with candles. So right here, right here, price sweeps liquidity somewhere right around, where's the sweep? Price sweeps liquidity right here, right? So this sequence of black candles going down, this is a sequence of black candles going down before we took this out, right? So what I would do is I would take this from this low formed right here all the way to this high. And then this would give me potential areas where price could go for me to target whenever I'm doing take profit. So say for instance, I entered in right there, right? I'll put my stop loss right here. And then this is whenever like the -1 and the -2 and stuff, that's when all that comes into play. So typically I'll try to target the -2. But this one right here is pretty high, I ain't gonna lie. So using like some discretion, like, you know, some ability to like think for myself, I'll typically choose this since this is a more likely area for price to hit. So yeah, that'd be a 2.75. This I'd probably be risking like almost 1,000 with how big the stop loss is. But yeah, that's all that Fibonacci tool does, is just help give me targets, like areas to target for putting my take profit at. If y'all want more of like a little smaller video, like how to write that up and stuff in the settings, then I'll make that. Just let me know. I'm gonna have more time to show attention to the YouTube channel since I'll have more free time now with my new job. So yeah, I'm gonna try my best. So now we are getting into the last topic, which is psychology tips and explaining multiple time frame usage. Now, I'm going to do the explaining multiple time frame usage part first, because that won't take long. The psychology tips won't take long either, but I feel like that will be a good way to end off the video, since I was most likely gonna do a tiny little rant anyway and try and get y'all like not motivated but like inspired to like actually take this serious. For anybody that's still watching, or you know, left to take a break and is back and you know they're serious about this, you know, the quote unquote rant or little speech at the end is gonna be like a little treat for y'all to help y'all, you know, get y'all started. So multiple time frame usage is, for one, at first I was on the 1 minute and the 15 second when I was first trading, but now I think I'm finna switch over to using the 15 minute and the 1 minute. So price is this thing. Price is what you would call fractal. So basically all that means is it's like stuff happening within itself. So say like you have a big square, right? You could put 4 smaller squares into that big square, right? And then you could put 4 more even smaller squares in the first 4 small squares inside that bigger square. So basically fractal is kind of like saying stuff happening within itself. So that's kind of like what pricing does. So like here, I'm just going to show y'all, how I do my strategy real quick. I'm not gonna go in depth, but I'm gonna show y'all the point of fractal, which basically I look for the same thing in both of my time frames. So right here we got that liquidity sweep coming into a fair value gap. We have this. At the time that I would be looking at it, it would be gray. Okay, we're good. That would be gray. This would also be gray at the time. Now I'm going to be patient. This gets inversed, and now it is a bullish inverse fair value gap. We then have we have a bullish fair value gap. We now also have a bullish fair value gap. We'll see what price wants to do with this. And then makes this orange. So once it makes that orange, I would then be dropping down to the 1 minute time frame at 13:15 on the dot. Where's my area? All right. 13:15, which is right around there. So 13:15 is where we would start. It touched it at 13:20. So what I'm looking for is, as we saw, guys, is that what we would be looking for is for price to take liquidity from the sell side, because that's what it did on the 15 minute. And that's the example of the fractal, like price being fractal that I told you is the same thing happening within itself. So price on the 15 minute, aka our higher time frame, took sell side. So now I'm trying to see that also happened on our lower time frame, which will be our 1 minute. So as y'all can see, where would that low be? Right here, price takes this low on the 1 minute eventually. Then we do that, coming into a fair value gap, a bullish fair value gap. Now let's see what's cooking up right here. Now I'm gonna look at all that fair value gap movement that I was doing on the 15 minutes. So no fair value gap yet. There's one right here. There's one right here, but it started out gray. There's also one right here. Also, guys, it doesn't matter how small or big the fair value gap is. Even the small ones could have a lot of power. So, sorry guys, I was looking at something else. So this eventually got turned into a bullish inverse fair value gap because it got closed past. Same with this one. And price came back down, made this one not mean anything, but then bounced off of that one. We still have that up there. That shouldn't be worried about in a minute. Now there is this inverse right here. Now seeing that makes a lot of sense now. So we're expecting a reaction to come down out of there. Hence why price pushed down right there, getting the full story. So there, right here is a bullish fair value gap. Now guys, also whenever it comes to fair value gaps and inverse fair value gaps, always expect a reaction from them, at any of them. Even if one gets closed past, if there are some above it, like right above it, expect the reaction to come from there. Never expect for price to just outright ignore a fair value gap. You want to see it push past it before you think it doesn't matter. So let's see. We saw this finally. So then we have an orange one right there, but we're expecting a reaction out of it, which we did get a reaction. It then causes this to turn gray. And then makes that, gives us a bullish fair value gap. Then right here it gives us a bullish inverse fair value gap. I mean a bearish inverse fair value gap. My fault. This is also bearish, and so is this. Anything gray is bearish, guys. We then close past this, making it not mean anything. We also take this low out, coming into this fair value gap. So then, now, this right here, a bearish fair value gap, and then gets closed past, making it bullish. Man, I still thought about it, still messed it up. Making this bullish. My entry would have been this right about there. That would have been my entry, because what I was expecting was, especially after price came here and made a sweep out liquidity coming into this fair value gap, and then inversing this fair value gap, turning it bullish. I'm then expecting for price to then hit this, to then tap back into this, to then make us continue higher. So let's go to the 15-minute. Yeah, the entry is still the same. We brought this up just a little bit. And then I would have took this, put this here. That -1. It hit the -1. Which is right there, which ain't bad at all. Sorry. See, we entered in at 13:45 and we would have got out at 14:40. Yeah, still same thing. An hour. So let's take out my trusty calculator and let's see how much that is, just to give y'all perspective on, you know. Also, like I'm saying, I'm speaking in context that I'm losing 556. Y'all gotta be willing to risk money if y'all, if y'all want to make money. Because I could be risking 556 and 4.38. So times 4.38. That's 2.4K right there. Now, what the beauty of that is, your goal is not to win every trade, but your goal is to minimize your losses and maximize your wins. Because you see how the risk to reward right here is 4.38. How that also plays into a factor is now saying if I'm risking around the same amount each trade, that's basically saying I have to lose 4 trades in a row now to be put at break even. So y'all see the power of it? That's what I'm saying. But yeah, that's how I analyze the market. I've also seen that with the 15-minute, it's a little easier to mesh the 15-minute and the 1-minute together. It seems to work a lot better. Excuse me. Than the 1 minute and the 15-second, most definitely. So I'm gonna start doing it like that. It is going to take a lot longer for my trades to form, but that is okay, just as long as I have the patience. And I'm probably gonna start trading multiple sessions now, since I'll be on the 15-minute, and literally 4 15-minute candles is an hour. So like from this candle to this candle was an hour. So yeah. But hey, the bread is definitely gonna be there. It's gonna be a lot smoother. I think I'll feel a lot more comfortable holding my trades out. Now let's see if this actually went to the -2 or not, where I would usually target. Let's see. stop this at a break even. So that's why I be using discretion sometimes, guys. Like, I don't need a 7.08 trade. But, you know, if you want to target the -2, then by all means. But I was perfectly fine with this right here, my good little 4.38. But let's check and see how much that would have been if it did hit that -2. So let's once again say we're risking 556 times that by 7.08. That would have been 3.9K right there. 3.9K. Now let's say you had a bigger account, which I'm trying to get a bigger challenge once I pass this 50K one, and you're doing a 500K account challenge, right? Well, let's say I'm pretty sure the normal amount I would risk on there is about 8,000. So you times 8,000 by 7.08, and you've made 56K off of this one trade right here. You made someone's yearly salary in like a day. So yeah. Shoot, this is a good opportunity right here too. If you just take it out right here and then you let price do his thing for him, because we took buy side. So now we're looking for sells, and then right here, shoot, that would have been the sell right there. Hell yeah, that would have been the sell for sure. It came down to that fair value gap and everything. I love this shit. All right, guys. So yeah, that's about it. As far as psychology tips, to round up this video, it's probably gonna be like an hour and a half. Yeah, guys, you're going to have a lot. The fundamentals and the technical analysis isn't the hard part. Well, it can be depending on the person, but the real hard part is the psychology behind everything. Which, what I mean is, like, people getting greedy, people getting impatient, people having a fear of missing out, and they're chasing price, and they enter in a position that they shouldn't even be in because they missed the move, or they feel like they missed the move, or price didn't give them an entry, or people blaming the market, getting upset saying it's all fake, it's a scam because they keep on losing. And then something I struggled with was basing whether or not I was a good trader on how many trades I lost and how many trades I won. Guys, when it comes to trading, what matters is not your take profit or how many trades you won or how many trades you lost. All that matters is that you just do what you need to do. You focus on getting your psychology right. You focus on mastering the skill of trading and being able to read the market like how I'm able to read them now, and just focus on following your rules. Eventually you'll get into what risk management is and stuff like that. And just focus on those things. And I promise you, the money and the profitability and the freedom and all that stuff like that, if you're doing it for freedom like how I am, then all of that will come in time. I don't know what time, I can't tell you. You could be somebody that's going to get it in 6 months, a couple months. You could be somebody that's going to take a year, 2 or 3. It could be somebody that you take 5 to 10 years to get it. But me personally, if this is something that could give me the freedom to do whatever I want, whenever I want, however I want, and live life on my own terms, why not give it as many months or as many years as it needs to take for you? Because once you get to that point where you understand it and it just becomes a part of you, then you'll be able to do whatever you want. And the quicker you start, the better. Because I was blessed to have found this and to have taken this serious whenever I was 18 years old. I'm 21 now, and I really think I started taking it super serious when I was 19, because when I was 18, I was like interested by it, but I didn't really put too much into it. But when I started going to school for business, because I always wanted to start my own business, and then realized that the business degree was not for starting your own business, and that I didn't need that to start my own business, I kind of was like, yeah, I'd rather go and do my own thing. And then I started picking trading back up again. I started going full force on it, and ever since then, it's just been, yeah. So yeah, I actually kept taking it serious when I was 18, because this year's gonna make 3 years I've been doing it. So yeah, I was taking it serious when I was 18. But yeah, guys, take this serious. Like, if y'all really want the freedom to like be at home or go on trips, like I went to Vegas. I went to Vegas 15 days ago, so 2 weeks ago, and all I can think about is how I want to go back and how I want to take trips and stuff like that, and just like live my life on my own terms and never have to clock into a job again. So, like, if y'all want that kind of life where y'all can just, just actually live life instead of going to work all the time, take this serious, man. You're probably going to be impatient and greedy when you first start. You're probably going to have FOMO and stuff. But remember, the market is always right. You just got to learn how to get in tune with it and just flow with it. Don't fight against the market. Don't try to outsmart it. Don't try to beat it. The market is always right. And all you need to do is figure out what side of the market you need to be on and at what time. But yeah, I believe anybody can do this if they put their mind to it, and the only ones that don't make it are the ones that basically quit with anything. They just quit, they gave up on themselves, or they gave up on it, or they listened to other people's opinions and stuff on it, and I don't know how many people that told me I'm crazy for trying this, and they're going to be the same people asking me for help whenever I make it, or same people trying to congratulate me, or be like, oh yeah, I knew him, me and him were cool whenever we went to school, and all that extra stuff. But yeah, take this info I gave y'all, do the absolute most with it that y'all can. If you're really serious about it, because I know one of my friends that are going to be watching this works 12 hours a day, and he works all the time. Y'all, please take this serious. Like, even if it's just 10 minutes out of the day to look at the charts and like look over what I taught y'all, or like on your off days, I know all y'all want to do is relax and chill, but think about how much y'all will be able to do that once y'all master this and y'all don't have to clock into a job no more. Think about how much you'll be able to chill then. If you think about it like that, I'd definitely be willing to sacrifice my off days, because it's not like you're gonna be on this the entire day, but still put time into this so that way you don't have to work for the rest of your life. But yeah, guys, that's pretty much it. I believe in everybody that watches this video and is taking it serious. Like I said, I'm gonna be doing a whole lot more with this channel. I'm trying to be authentic. I'm trying to not show y'all the lifestyle. I'll worry about that. Eventually I'll do day in the life, but I'm here to give y'all true value. So yeah, I believe in everybody that wants to take this serious. Don't think about how long it's gonna take you. Just go for it. Don't count the days. Don't count the months. Just do it. Just every day. Just show up, and I promise you, it'll all click eventually. So I appreciate everybody for watching. I appreciate my cousin and my two friends that asked me for this video. Well, really my cousin. I made it for her, and then my friend asked me to teach him, so I made the video for y'all, and it's gonna go up on YouTube for anybody else watching. So yeah, I appreciate y'all for watching. Hopefully this video is helping y'all get y'all foot through the door, get y'all started, get you pushing y'all forward. And if anybody ever wants a topic on a certain video and stuff, just let me know. Oh, and live trading videos coming soon. Live trading videos coming soon. It was not the best week this week, but just like every week or every weekend, we back test, we fix what we need to fix, and then we come back the next week. And like, if we have clarity, we'll come back the next week and we'll just get back to doing what we need to do. But yeah, I'll talk to y'all boys later, and I'll see y'all in the next one.